Well, without any further ado, let's bring on board our very first guest for today. We have with us Mr. Uday Dhoot of Venn Wealth. Uday, thank you for joining us on the Money Show. As always, a pleasure having you with us. So to start with, senior citizens, they need some risk. I'm sure they need lesser risk, pardon me, compared to younger people. But returns, of course, the more, the better. So if you could just talk to us firstly, what are the features in an investment product that senior citizens should look out for that will be suitable for them?
So let's understand where a senior citizen is. And when we say a senior citizen, we are not just talking about age, we are also talking about a specific stage in life wherein possibly your active work is over. You might still be consulting, you might still be doing some social work, etc. But your active earning work is over. You have your kitty. So here the most important thing, there is a starting point, right? So you have an amount of money that you have saved over the last many decades that you have been working. And what you need to provide for is that you need to provide some kind of a regular income, almost like the salary that you used to get, or some kind of a rental income, a regular pension income, so that your months on month expenses are taken care of. So that's the most important basic requirement. You have a kitty of money. You want to convert that kitty of money into small bits and pieces to last you through your lifetime. So that's where a senior citizen is. Now, when you start thinking about it, what kind of products are well suited for a senior citizen depends on multiple things. The most basic thing it depends on is that what is your starting kitty, what is your monthly requirement, right? Let's say if my monthly requirement is just say 20,000 rupees a month, and I have 2 crore rupees as my starting kitty. Maybe very comfortably I can put aside this money in a fixed deposit, earn say 10 12 lakh rupees in a year, spend my 3 4 lakh rupees, and still have 8 9 lakh rupees of savings to sort of flow back into my savings, right? But this equation can change. I could have just about of money in my savings which just meets my regular expenses, which means that if inflation goes up, the cost of living goes up, then my kitty may not be sufficient, right? So the starting points are all these. What is the starting kitty? What are your regular expenses? Are there any specific health issues that you should be worried about? Apart from that, are there any specific goals that you want to take care of? It could be that people want to have some travel goals, some philanthropy goals, some goals of estate, etc. So you put all of this together and see, map where my assets are, what are likely expenses, and how do I basically map through that. Now, the challenge that senior citizens have as compared to all the rest of the folks who are still learning, that they're primarily in distribution phase, which means that they don't have fresh money that they can bring to the table. This is it, which means that the way the decision making is being done for this part of their money is that we need to imagine that there is going to be no more fresh money that needs is going to come in. So it has to be done in a very diligent manner, which is why there is some reason for safety, there is some reason for regular income. Now, how a senior citizen needs to start thinking about it, that don't think of this whole lifetime from say the time you retire from active work, say imagine it's age 60 to 85 as just one phase. It is not one phase. It might be 20 years, 2 decades, 25 years. One does not know. Let's imagine it's 2 decades, from 60 to 20. What you need to start breaking down is that break them this 20 years down into 2 3 different parts. Make sure that you have very stable cash flows for the next 2 to 3 years, very clearly planned out. No headaches. It does not matter where the markets are. It does not matter where the economies are. You will get your regular income. Then there is a, imagine a next phase, 3 years to 5 years. Then again, you have something else, which is equally safe. So maybe if the first portion was in fixed deposit, senior citizen, and such schemes, the second set of money is in debt funds. Again, very, very safe money there. Beyond that, now you need maybe some growth, maybe some stability. So you will have a mixture of long-term bond investments. You will have a mixture of, say, uh, some equities to keep up with inflation. So that's how you start breaking down things. But the starting point is always your regular expenses, your goals, your requirements, and then matching them with the kitty that you have already sort of built for yourself.
Okay, so to start with, list down your expenses, and then you take your kitty and sort of invest it across different assets. We'll be discussing which exactly are those assets. Uday did briefly mention a few, some long-term bonds, a little in equity as well. So Uday, how should let's say if somebody is dependent on this kitty to generate them an annual income, a frequent source of income of sorts, what do you think is one of the best investment options? And goes without saying, credit risk or any sort of risk at this point of time for senior citizens would obviously be very, very intolerable.
Talk about risk, Mubina. Before I talk about risk, let's just imagine, and I'm going back to the example that I was sharing earlier. Imagine that there is a senior citizen with a monthly requirement of 25,000 rupees a month, which is 3 lakh rupees a year, right? And for a moment, let's imagine that a fixed deposit rate for a long, which is, let's say if I do a 10-year or 5-year fixed deposit with SBI, let's say it's around 6.5%. So if all the kitty that I have saved is 25 lakh rupees, then obviously I am running short of my annual requirement, which means I will very soon start digging into my kitty. I could be in a stage wherein say my kitty today is 50 lakh rupees, which means that at 6%, I'm just meeting my regular expenses. If there is anything else that comes in between, like a medical emergency, high inflation, suddenly I might start dipping back into my corpus. Let's say I have a corpus of 1 crore. Then I'm getting 6 lakh rupees, which gives me 1 year's regular income if I put that money in fixed deposit. So I could very well say that, hey, put in a case like that, a good 60% of my money in a fixed deposit in debt funds to generate, or senior citizen scheme to generate regular income, and the remaining money in some amount of growth, so that over a period of time my money keeps growing also to keep pace with inflation. So the whole point is that you start looking at these numbers and then start tracking as to where you are, because your choices will be sort of determined by what you end up as such doing. So that's the kind of starting point for pretty much everyone. Your expenses, your kitty, and then seeing that, hey, I'm able to generate that regular income from my safe investments, and I still have some money left. How could I then sort of put that money in a safe way aside to sort of grow so that I can keep with inflation? The point about not taking risk, I think, is incorrect, and I'll tell you why it is incorrect. What is risk that a senior citizen has, right? And I sort of alluded to some point saying that, hey, the thing about senior citizens is that they may not have any more regular income. So in case the portfolio value goes down, they are not necessarily always in a position to sort of bring in fresh money from their regular incomes, because they do not have regular income. But that does not mean that they do not have to have an asset allocation approach, that they cannot have some part of their portfolio taking risk to create value for them. And I'll tell you why. See, the thing is that let's imagine for a moment that I need 3 lakh rupees a year and I have 1 crore. If I put in 50 lakh rupees in fixed deposit for the next 10 years with SBI, I'll keep getting that 3 lakh rupees every year. Okay. Which means that I have security for the next 10 years. I still have 50 lakh rupees remaining with me. I could maybe then start putting aside some part of that money, say in a senior citizen scheme, in a debt mutual fund, so that I can get yield a slightly higher return, right? If you do this LIC pension, that PMY scheme, which is there, then you get almost 7.6% return there for the next 10 years. So you could obviously generate slightly higher returns. You can then still afford very easily to put aside, say, 15-20% of your money in growth assets, so that over the next 10 years, if that money grows by 10-12%, it creates enough cushion for you to move at that point in time that portion, that growth of equity money, into some kind of a fixed income security, so that as inflation keeps going up, you are able to generate higher amounts of regular income. So some amount of risk we need to take in the portfolio, but please understand that risk is not necessarily a risk which is there, because there is a very clear 10-year investment horizon out there. You don't need, as a retiree, if I have saved up 1 crore rupees or 2 crore rupees over my career, I don't need all of that money on year one of my life. I need that spread over the next 20 years. So I think there is very much capability to take risk. It's just that we need to bucket them nicely so that in the short run, I don't have to take the hassle of figuring out where the markets are, where the economy is. I'm getting my regular income. In the long run, there is some growth asset which is taking care of inflation and making sure that my costs, even if they run up, are taken care of.
Okay, so don't be completely afraid of risks. Basically, that's, the word is well coming in. The common notion obviously is that, as you grow older, your risk-taking ability does go down. Yes, it does, but that does not mean you make some sort of a zero risk profile, because that in turn will also hamper your returns, obviously. You mentioned Uday, the PM Vaya Vandana Yojana in your answer, which is offering almost 7.6% return. Since we are on the topic, what do you make of this scheme? Do you think that senior citizens should one?
I think it's a very good scheme for senior citizen schemes. The only sad part I would feel is that you can only put in 15 lakh rupees. It has very nicely been designed to get like a regular monthly income. You have clarity for the next 10 years. You can generate regular income. Just that you can only put in 15 lakh rupees there. I think that's for me a slightly, if people want to put in more money, but I think that's a very good scheme to be part of your portfolio. Likewise, the senior citizen scheme that you can invest through the post office, right? Again, that's a good place to park in some of your money. Long term money, you are assured of your regular income, right? The example that we're talking, let's imagine if somebody has 1 crore rupees, you put in 30 lakh rupees into the senior citizen scheme in this pension yojana of the government through LIC. You know that on that 30 lakh rupees, 7%, at least this 2 lakh rupees or so, 20 or thousand bucks every month, I will keep getting. And that is guaranteed. I don't have to go ask anyone. It will just come and hit my account on a regular basis, right? So that's the advantage of having some of these investments in the portfolio. Obviously, you have to supplement them along with other investments as well.
Okay, so if you could just sort of maybe, when you say supplement with other investments, according to you, how would you curate a portfolio for, a senior citizens? Like you mentioned, the PM Vaya Vandana Yojana is a great scheme. So I'm sure that would be included in the portfolio. But what are the other investment instruments you'd recommend for them?
To curate a portfolio is obviously depends on what is the starting point of the corpus and the regular requirements, because that sort of determines how much regular income needs to be generated. The more regular income needs to be generated as a proportion of the corpus that you are investing in, you are that much restricted, right? Because you then need to do those kind of investments only in instruments which give regular income. So bonds, fixed deposits, senior citizen schemes, some debt mutual funds. You could maybe do like an STP, SWP kind of a route to create some regular income out of those things. And then after that, the way I would think about is that once I've taken care of the regular requirements for say at least say 3 to 5 years, I have that much visibility because I'm assuming a cycle lasts that long. If I have like put that visibility, let's say the first bucket, the second bucket, the third bucket, I've created enough sort of safety cushions for the investor, then I will start doing some amount of money in growth assets. Again, depending on how that individual is, has he invested before in growth assets? What does he feel? See, sometimes what happens, grandparents or senior citizens want to leave aside some money as estate, in which case they are investing maybe for the grandchild, which is saying that, hey, my grandchild is maybe 2 years old right now. I want when he's 15, 18, I want him to get this money. So there, if you see, there is enough risk-taking capability because you want to grow that asset. So let's say you put aside, say, 2 lakh rupees instead of making an FD in your grandchild's name, you put aside 2 lakh rupees or 5 lakh rupees as mutual funds in his name. It will give him a much higher growth assets if it is invested in equities or some kind of a hybrid scheme, right? So understanding where that individual is and then sort of allocating the resources accordingly.
Just wanted, a lot of senior citizens, the fact that firstly they are from maybe, the 60s and 70s, they any which ways, or rather 50s and 60s, pardon me, they any which ways do tend to have this aversion, when it comes to equity investing. So if I could specifically get in your view on whether senior citizens should invest in equities, direct equities or equity funds.
The whole I know of some senior citizens who have always been investing in equities, and they're comfortable owning equities, right? They would have held some stocks from IPOs, and they continue holding it for long. Stuff like Reliance, ACC. I know such people, right? So I think it's an experience that the investor currently holds. A senior citizen, once you reach that age, might be a wrong time to try a lot of new things if you've not done them before, right? It is hard for the person to then sort of understand something like this, wherein it might be difficult to sort of give them direct equity exposure. Maybe start them off with hybrid, explain to them why it makes sense, why it is a small portion of their portfolio, but and slowly build that experience. I look, the point is, I'm sort of repeating this almost like a tape recorder, is that uh, if one is a senior citizen, does not mean that it's just a 12-month investment horizon or an 18-month investment horizon. It seems like that. Once you make them see that, hey, you have 10-year money, you have 15-month money, you have 20-year money, I think their own experience of investing will be very different. It might require a fair amount of hand holding, so that they know that at any point in time their cash flows are not disrupted. They don't have to go and ask anyone for help. Their own financial independence is never compromised. If you take care of that, if you take care of ensuring that you will have your money when you're required, you can slowly nudge them for some amount of money in equity funds. I would not maybe recommend them to do direct equity, but like I told you, I know people who have always owned stocks, and they will own stocks because they say that, hey, these stocks are going to my grandkids. I'm going giving it to them, kind of a thing.
All right. Okay, well, but there is this tendency sometimes for senior citizens to stick to their traditional mode of investments. And when I say traditional, is mostly fixed deposits. So, but yeah, of course, there's another class of people who do own very, very old stocks from the IPO times. In fact, some of us also do have the shares of, Tisco, as it was called back then, or many of these really grand old companies of India that have been passed on by our grandfathers, great grandfathers, because they had the wisdom of purchasing these shares, when these companies came out with their IPO, the initial offering. So, yeah, of course, in that way, Uday, you're absolutely right. Some of them with the enterprise had accumulated some of these individual shares, but still some senior citizens are very, very averse to equities and rather stick to their traditional fixed deposits. But yes, you've got to understand now that obviously fixed deposit interest rates are down. As a 1-year FD now generates barely 5%. So it's definitely something that will hamper, your ability to meet your day-to-day expenses, especially if you're depending on these investments to be able to generate a frequent income for you. And, inflation itself is at 6%, right? The RBI as well said that, look, inflation will be a problem. So whatever 5% that you will be earning, 6% will be eaten away by inflation. So it's also important that you need to understand that firstly, your time horizon is not just 12 or 18 months. Secondly, don't be completely risk averse. It's okay to take on board some risk. But just because you're a senior citizen, that does not mean that your risk appetite boils down to zero. I think those were some very interesting takeaways that Uday Dhoot gave us today in the conversation. Well, if you're a senior citizen watching this show, if you want to ask for your parents, you can write into us on the Money Show at etnow.tv. Uday Dhoot will be here to get your questions and queries answered. So let's take on board our very first question, a very interesting one coming in on expense ratios from Santu Mondal. Now he says that high return for high expense ratio, low return for low expense ratio, and he's given the examples as well. For example, according to him, a Parag Parekh long-term equity fund has a 1.0 Yeah, he's given a fund, he's given a expense ratio for that, though I'm not too sure if it's the right one. And he's given the example of a UTI Nifty index fund. The fact that it's an index fund means obviously the expense ratio will be a little lower. So he wants to know which investor is a gainer in the mathematics of expense ratio versus return. Okay, so how much should individuals consider this factor called expense ratio when they are picking equity mutual funds to invest in, according to you, Uday?
Yeah, I think there is no denying the fact that expense ratio is important. And like they say, performance is fleeting, but expenses are permanent, right? So for two comparable things, you would always take one with lower expenses. Having said that, I'm not very sure if the comparison that we get here is absolutely right. We are comparing an index strategy, ETF strategy with an actively managed strategy and comparing the cost. I think the point is that the portfolio is made up of multiple such ideas. So when we look at the cost, we look at not only the individual cost, but what the individual schemes bring to the total portfolio, right? So if let's say I have 100 rupees to invest into equities, I would want some of that money to be in index and ETFs. I would want some of that money in to be in actively managed funds, and that's how I will manage my expense ratio. At the same time, ensure diversification and growth of my assets over the long period of time.
Okay. So yeah, firstly, if you have a long period of time, maybe the dependency on expense ratio would change accordingly. I mean, what sort of an impact will it have on your fund and your returns? It will change accordingly. So you need to take note of that. Let's take on board our next question. Shankha Sen writes that he's 37, lives in Andhra Pradesh, and has a 20,000 SIP in mutual fund since the last 1 year. His time horizon is 24 years, till 2043. Okay, it's 24 years till 2043. He wants to know, is it okay for him to expect his portfolio to deliver 11 to 12% returns? He has, roughly about 5 odd funds: SBI Focused Equity, Mirae Mid Cap, SBI Small Cap, Kotak Standard Multi Cap, and Parag Parikh Equity, in which he invests 4,000 per month. He has a couple of debt investments as well, PPFs, company PF, some emergency money as well, parked in the ABSL Money Manager Fund. So he wants to know if he can achieve a corpus of 3 to 4 crores in the next 23 years. He's also ready to increase SIPs by 10 to 15% every year. And he already does top-ups when his, when the Sensex or Nifty goes down by 3 to 500 points apart from the regular SIP day. I think largely, Uday, he seems to be ticking all the right boxes, except I have a question on this 3 to 4 crore corpus. We are talking about 23 years later. He's 37 years, so he'll be 60 by then. Do you think this 3 to 4 crore corpus would suffice?
The question of whether 3 to 4 crores will suffice depends on what his regular expenses are, right? So it's really hard to say that. I wish Sankha had shared that information also with us, but seems like he's done a fairly good job out there. He's sort of doing pretty much all that you would expect a disciplined investor to sort of do, which is all plus points to him. The only thing that I want to sort of not give him the comfort of is saying that, hey, yes, you'll reach your corpus. The thing is that when you're thinking 24 years forward, 30 years forward, it's very easy to put these percentages in Excel and see the money grow. But in real life, the growth of money is very, very different from how it grows in Excel. So I would say that, hey, whatever you are thinking, be more conservative in your assumptions, be more aggressive in your savings, and keep sort of checking back, saying that, hey, are you on the right path or no? But today, I think you seem to be in the right place. Obviously, you want to keep looking back, saying that, hey, whether 3 to 4 crores is sufficient to cover your regular expenses, the kind of lifestyle you have today, the kind of lifestyle you're likely to have 20 years forward, because you will be earning, your lifestyle will keep on increasing, so you might need a higher degree of value. But again, I think you're on the right path. Keep on it and keep checking back on these numbers every couple of years.
Okay, you're on the right path, but make sure that you keep checking in. That's basically to say that you keep, reviewing your portfolio at frequent intervals. Okay, I think last query for the day, we have Nayan Gandhi who writes into us saying that I had invested in Nippon Liquid Fund. My amount, instead of increasing, had actually gone down as the market went down. And when he asked Nippon, they said that if the market falls, your value of your investment as well will fall. So he wants to know, how does this work and what should he do? Okay, a liquid fund, relatively safer compared to, other debt funds or equity funds. But of course, when the market went down, the value of his fund as well went down. That's at least what Nippon has told him. So how does a liquid fund work? And what should Nayan do? I mean, see, again, he's not mentioned why he's put his money in the liquid fund. And I'm sure it's for a short-term purpose, because the fact that you're in a liquid fund means that you've just parked it temporarily. But, what's your opinion on this Nippon liquid fund?
Mubina, frankly, I'm not very sure as to if we have the right data set. It would have been great if we had Nan on the call to get more information on what is being referred. See, liquid funds, the whole structure over the last few years with how SEBI has come about and very clearly sort of told what the investment criteria for a liquid fund is going to be, what kind of assets can go into a liquid fund, and so on and so forth, has made this whole category very, very safe. Now you have to understand that any kind of debt mutual fund, so liquid mutual fund is also kind of a debt mutual fund, carries two types of risk in its portfolio. One type of risk is the risk of credit, right? So you invest, basically mutual funds take the money from us, they sort of in turn lend this to other companies, government, corporate, bonds, banks, and so on and so forth. So every time you give the money to somebody else, there is some risk of credit there. And the second is that the interest rates can go up and down. And if generally the way bonds work is that if the interest rates go up, then your bond prices go down. Though that impact is very, very limited and minimal on a liquid mutual fund until there are big changes in interest rates. So the only thing that you then have to worry about is credit risk. So I'm not very sure whether this seems like an ill-informed decision. I'm not very sure whether it was somebody from Nippon or something. They don't the debt fund, the liquid mutual funds have nothing to do with equity markets, right? There is basically interest rate risk and there is credit risk. If either one of them has played out is when you will see negative returns on your portfolio. So I'm not very sure if there was any specific incident. Is this some other fund that he's invested in? Normally in liquid funds you would not see negative returns.
All right. Okay, there you have it. I hope that's answered, your conundrum, your query that you may be wondering when it comes to Nippon Liquid Fund. Okay, well, on that note, we're out of time, so we'll not be able to take any more questions. Folks, if we've not been able to take your query, don't fret. We will definitely take it on board in our subsequent episodes of The Money Show. So keep writing into us on themoneyshow@etnow.tv. Uday, thank you as well for patiently answering all our questions and queries for our viewers and helping out, especially all our senior citizens as well, when it comes to their investments, busting some myths too when it comes to time horizon and risk.